Hi everyone, this is Lauren Williams, and today we're going to learn how to read a loan estimate. This is a very important document, and once you get pre-approved and you go shopping and you find the house that you love and you put an offer in on that home, your offer gets accepted. Yay, that's the most exciting part, your offer getting accepted. Then within 3 days, your loan officer will send you this loan estimate. It is just an estimate, but it's very important. It's important because it goes over your loan terms. And so you want to pay attention to this and understand it. And so we're going to go through it today so you can understand it and make good choices when you're shopping for your mortgage. Okay, so we'll get started. This was a previous client of ours who closed in December. It was a VA loan. Him and his wife decided to purchase a quadplex. So it was 4 units. They're living in one of the units as their primary residence, and then they're renting the other 3 units out. And so the tenants are essentially paying their mortgage for them. It's a great strategy. We can teach you how to do that. We can structure your file to do this as well. And if it's not a good time to buy a quadplex, then you can always start with a single family residence as well. Okay. All right. So at the top, we have loan estimate. You have the date it was issued, you'll have your name, your property address, the sales price, and then loan term, 30 years, purpose is purchase, not a refinance, product is a fixed rate mortgage, and then loan type is VA. Right here where it says rate lock, very important to look at because that will tell you if your rate is locked in or not. This one was locked in at 6.75 when we sent out the loan estimate, but sometimes your rate is still floating. Maybe your loan officer has said that they think that the rates will go down in a few days, so they may float your rate. You may not have been ready to lock in your rate yet. You wanted to wait. So that's what that's for, to verify if your rate has been locked in. Even if your rate has been locked in, you still can go mortgage shopping. So don't let that scare you and think that you can't shop at this point. Nothing has happened too much right now. Maybe the appraisal's been ordered, things like that, but you still have a little bit of time. So if you do have a loan estimate and you would like us to take a look at it and see if we can save you some money, whether it be on the interest rate or closing costs, we would be happy to do so. We can close loans pretty quickly, within as quickly as about 10 days. So, all right, let's keep going here. So loan terms will be the first section. Your loan amount will be there, your interest rate, principal, and interest payment. As you can see, the loan amount is higher than the sales price. Why? Well, because there's a VA funding fee. And so for first-time use, less than 5% down, so 0% down, 100% financing, then you would pay a 2.15% funding fee. Okay, so you would take the $620,000 times 2.15%, and then that'll bring you here to your funding fee amount of $13,330. That's where we come up with that number. Some people can finance it, so add it into the loan amount, or you can pay it at closing. Most people decide to just finance it and add it into the loan amount. Okay, so they were locked in at 6.75%. And then over here to the right, you'll see it says, can this amount increase after closing? No, it cannot. This is a fixed rate mortgage. It's not an adjustable rate mortgage. These terms will not change. Okay. Next section, prepayment penalty. Does a loan have these features? No. So that means that if you wanted to pay your mortgage off sooner than 30 years, then you could, and there's no penalty to do so. So you can pay it off early if you'd like. A lot of times people will ask us, is it best to do a 15-year mortgage or a 30-year mortgage? What I always advise is do a 30-year mortgage. Usually, that's what we would advise. Go ahead and get a 30-year mortgage. And that way, you can make double payments, extra payments every month, but maybe something could happen where maybe you couldn't make that extra payment, and then you're not held to it in a 15-year mortgage, making those double payments, those higher payments. But you can definitely do so with a 30-year mortgage. You can make extra payments, and there's a strategy to that as well. So you want to make sure if you are making an extra payment each month, that you make sure that extra payment goes towards principal only. So you could tell your loan servicer that, whether you pay your mortgage online, or you could call them and ask them if you're not sure. But you want to make sure that if you do make extra payments, that those payments are going towards the principal. That's going to help you pay that mortgage off sooner. Okay. All right. Balloon payment. Is there a balloon payment? No. So balloon payment would be a good idea. Say that in a few years, 7 years, you know you're going to come into a lump sum of money and you're just going to pay it all off. But you want to have minimum monthly payments, like smaller mortgage payments until then. So you may make smaller mortgage payments 5 to 7 years. Here's this balloon payment. It's due. Now the whole mortgage is due before 30 years. That would be the only reason why that could be a good idea. Most people would just do a 30-year mortgage. A lot of people aren't going to come in, with a big lump sum of money to pay that mortgage off. So, no, there's no balloon payment. It's just a standard 30-year fixed mortgage. Okay. Projected payments. So, payment calculation years 1 through 30. These items don't change. Principal and interest stays the same. There is no mortgage insurance for VA. For FHA and conventional, there is a monthly mortgage insurance, but for VA, there is not. And then the next section is the estimated escrow, $365. That's your homeowner's insurance and your taxes, which makes your estimated total payment at $4,473. Next section, it will break that down, what is in your escrow, and it's going to be your taxes and your homeowner's insurance. Both of those are checked. They're both going to be in your escrow account. Your loan servicer is going to set up your escrow account for you. So each month your insurance and your taxes will be paid out of that account. The money is set in that account to pay for next year's homeowners insurance and taxes as well. And so we'll go through that in the itemization. Okay. The only item you won't see here in estimated taxes, insurance, and assessment that will be escrowed is an HOA. HOAs are not escrowed each month. You'll pay that separately. So if you do have an HOA for your community, you just want to factor in that HOA payment, that HOA fee in your total payment, okay, whenever you're budgeting. All right. Okay, so right at the bottom of page 1, you'll see costs at closing. Estimated closing costs, $32,867. Estimated cash to close is negative $2,463. So that means that this husband and wife, they're actually receiving money back at closing to buy this quadplex. It's just pretty amazing. And I'll show you how we do that. Okay, we'll get down to the bottom here and I'll show you that. So let's just go, let's look at the itemization of the closing costs first. In section A, your origination charges, if your loan officer charges an origination fee, which we do not, that would be there. Any application fees would be there. We don't charge that on VA, but there, and also points. So here, this client chose to pay points, 1.757% of the loan amount, which equated to $11,128. It's a lot of money. It's a lot of money to pay down your rate, but I'll tell you why we did that. If you come down here, calculating cash to close, and you look at the seller credit, I can't highlight it, sorry, but the seller credit is $20,000. That was one of our real estate agents on our team. They were able to negotiate $20,000 from the seller. So these buyers were able to buy down their interest rate. So the mortgage payment made more sense to them for their budget and pay all of their closing costs. And they actually received money back at closing. So that's why these clients decided to pay so many points, is because they had the money. They had the money from the seller to buy it down. So now the mortgage payment works better for their budget. Okay. We do this all the time. Most of our offers that we get accepted have seller credits to help pay for rate buy downs and closing costs. Okay. Section B, services you cannot shop for. So these are items that us as a lender would charge. The appraisal is required. So we'll have an appraiser go out and he or she will inspect the property, tell us what the value is based on their educated guess. This is their craft, and they use comparables within the area, usually within a mile, the 3 mile, maybe a mile, 2 mile radius. It depends on the type of property. If it's in a suburban area, it may just be within a mile, even less than a mile. If it's a more rural area, they may have to go out a little bit to maybe a couple miles, 3 miles. So that is a required fee. This one was a little bit more expensive. The appraisal fee you'll see here is $1,000, and then we have an operating income statement of $75. And then a rent schedule of $150. The reason why is because this is an income producing property. So the appraisal was a little bit more. Typically, those fees are about $650 to $750, so not as high typically as you'll see here, okay, for a single family home. And then you'll see that VA funding fee that I spoke about earlier. So that's showing here as a closing cost, but it will be subtracted at the calculating cash to close because it's going to be financed into the loan. That's why you saw the loan amount was higher than the purchase price. So we'll go over that again at calculating cash to close. Okay. Section C, services you can shop for. So these are all of your title fees. They're estimated fees from a local title company here in Colorado Springs. We would just look at the local area that you're in. We will pull those fees from a local reputable title company, but you can shop for those. So you can talk with your agent and say, hey, I'd really like to use ABC Title. Okay, we can do that as long as the seller agrees as well. It's in the contract, and then we can use use that title company, and we'll add their fees in. Okay, we like to overestimate these fees because we don't want you to be surprised whenever you get your final numbers, whenever you get your closing disclosure a few days before closing. So these fees are usually a little bit higher than what they actually will come in at. Okay. Next section, Section E, taxes and other government fees. You've got recording fees for the deed, transfer taxes. Section F, prepaids. So this is how we set up your escrow account that I was talking about earlier. We'll always collect 12 months upfront of your homeowner's insurance. So we've got 12 months of your homeowner's insurance to set up that escrow account. We've got prepaid interest here. As you can see, it's 3 days of $117.12. So the way the prepaid interest is calculated is you will pay from the day you move in to the end of the month. And so they moved in towards the end of the month, and so they only had to pay 3 days of prepaid interest. I don't know, some people, I don't know if you've heard, but some loan officers will say, well, purchase your home and then you don't have another payment for another 60 days. There's a strategy to do that. So the way you would do that is you would close on your home around the first of the month. So say February 1st. If you close on your home February 1st, your first mortgage payment will not be due until April 1st. So that's a whole 60 days of being in the home without a mortgage payment. But if you move in the first day of the month, then you have to pay all the interest for the month. So are you really getting an extra payment? Completely up to you. You can do that. Sometimes you have to. Depends on the seller too and their needs. So you may have to close at the first of the month. So you can do that. You just pay more prepaid interest, and then your first payment will be due in 60 days. What you can do as well, and it reduces the closing costs, is you move in towards the end of the month. So say if you move in at the end of February 28th, you only are responsible for 1 day of interest, okay? But then your payment will be due April 1st. So that's just something that you would want to consider and look at the numbers and see if you really are conscious on the closing costs. You may want to, and we aren't able to get a seller credit, which again, we are getting seller credits, then you may want to consider moving in towards the end of the month. If we get a seller credit, we get all your closing costs paid for, maybe you should move in towards the beginning of the month, okay? All right, so next, letter G, initial escrow payment at closing. So this is a cushion that we're going to collect for homeowners insurance as well for your escrow account. So there is a cushion. Again, every year they do reassess homeowners insurance and taxes. And so, they could go up. So we have a little cushion there of 3 months. And we're also going to collect 8 months of property taxes. So property taxes are actually paid in arrears. So they've already been paid by the seller. So you'll actually receive a credit from the seller for the aggregate. For the taxes, you'll receive a credit at closing, but then we're also going to collect a little cushion there for your escrow account too, okay? All right, so now we get down to letter J. Total closing costs was $32,867. Calculating cash to close. So total closing costs, you have that $32,867. Closing costs financed. So that was that VA funding fee we spoke about. You do $620,000, and then times 2.15% comes out to the $13,330. Okay, and then we'll subtract that because it's going to be financed, and then your earnest money deposit of $2,000. So the borrowers put down $2,000. Typically, the earnest money deposit that you'll be putting down on the home and the money will be held at escrow at the title company once your offer is accepted. Typically, that's 1% of the sales price. Typically, but not always. So you see here, the sales price was $620,000 and the earnest money was only $2,000. But just be aware that it typically is 1% of the sales price, and you can negotiate that with the seller and with your agent. Seller credit of $20,000, and so you subtract all of those items and you come down to the estimated cash to close at $2,463, more than the earnest money. So how did that happen? How did they get more than what they put in? Well, for VA, you can actually get a credit for the aggregate adjustment for the taxes as well. So that's why you see that they're actually receiving more than what they put in, the $2,000 of their earnest money, which is great. And so another really great strategy for VA is if we had additional seller concessions. So say the buyers didn't want to buy the rate down to 6.75 and they had extra money and they had some credit card debt or they had a personal loan they wanted to pay off. With VA, you can actually use the seller credit to pay down credit card debt, loans, pay them off. It's a really great tool for VA buyers to use. And so maybe that's what you decide to do. You know what? I just want to kind of be clean with my debt, just have my mortgage payment, my car, and I'm going to go ahead and pay off some credit cards and student and loan debt. Absolutely okay. Perfectly okay for VA. So and we can walk you through that strategy and how to, and look at the different scenarios. Which scenario would be best? Should I buy down my interest rate or should I pay off my credit cards? We can look at all of those options so you make a good decision whenever you're purchasing a home. Okay. All right. So next section here is talks about comparisons, your APR. That's most important here on this page is the APR. You want to pay attention to that. So let's go through what an APR is. Okay. An APR, in a simple way, it's when you borrow money, you usually have to pay it back with a little extra as a fee for using that money. So it's like renting money. The APR is like the total cost of borrowing for a year. It includes not only the amount you borrowed, but also any extra fees or interest that you need to pay back. Okay. So say just a really quick example of math for APR. So you want to borrow $100. Well, the interest rate's 10%. Okay, well then you're going to end up paying back $110 because for borrowing that $100. It's really, in a simple way, what the APR is. So you want to look at that number and you want to make sure that you're not overpaying for financing. Okay. Other considerations? So sorry. Appraisal. We may order an appraisal. Yes, we will order an appraisal to see what the appraised value is. And it also protects you because you don't want to pay any more than what it's worth. Okay. Assumption. Is your loan assumable? Yes, VA loans are assumable. Homeowners insurance. The loan requires homeowners insurance. So if you have a mortgage on your home, then you are required to have homeowners insurance. If you owned your home free and clear and you had no mortgage, then it wouldn't be a requirement to have homeowners insurance. There is a late payment fee. So if you're more than 15 days late, there's a 4% charge. Refinance. You're able to refinance. We can help guide you on when it's a good time to refinance. Once you make 6 consecutive payments, then you will be able to refi. We have a really amazing algorithm here where our system prompts us when our clients are ready to refinance based on their loan. So it's a great time for us to reach out and say, hey, I think it might be a good time. Let's look at this scenario and see if it would be a good time to refinance. And of course, our clients reach out to us all the time too. Oh, I closed 8 months ago. Do you think it's a good time? Sometimes it is, sometimes it isn't. So we look at that. We look at that and we'll give you an educated, our advice on if it's a good time or not. We're not going to tell you it's a good time to refinance if it's not and waste your money. Okay. It has to make sense financially. Servicing. So for this one, we did intend to service the loan. A lot of times loan lenders, they don't service the loans. A lot of them will sell them. You will make your first payment to them and then they will send you a letter and it will be a goodbye and then a hello, here's your new servicer. You've moved from, U Mortgage to PennyMac. And so then you'll have all of your payment information with PennyMac. This happens often, more often than it doesn't. So, but with this situation, we were going to service this loan. So if you get the documentation in the mail that states, oh, we sold your loan over to a new loan servicer, don't be alarmed. It's very common. If you have any questions or if you're concerned if it's real or if it's spam, always reach out and we'll help you and we'll let you know for sure if it's a legitimate mail from us or not. Okay. So if you have any questions, please put those questions in the comments. You can reach out through a private message. Me and my husband, Jason Schmier, we work together as loan officers and would love to help you out as well. So we're always an open book and willing to help and educate. So my phone number is 757-217-7614. You can call or text anytime, and we look forward to speaking with you soon. Bye-bye.